Bring in Markus Helsing of Alpha Broking. He's in our Melbourne studio, joins us live. Markus, kicking it off with gold, because there's a lot to sort of talk about when it comes to the macro environment at the moment. We've been discussing it throughout the show, obviously Deutsche Bank, Brexit, US presidential election. I mean, how does this culminate for you when it comes to gold?
Well, I mean, look, I started in this industry in the 70s, and America was just about hitting an inflation rate as high as 16.5%. The short rates were above 20% in 1980, and people walked around with gold and silver bars in 1979 and 1980. Now, it feels to me like this is like a renaissance in a potentially much bigger way. While we had in the late 70s pure speculation on inflation that led silver and gold to these higher prices, this time we actually do have the end of a 35-year credit bubble that's coming to a conclusion. So this whole Deutsche Bank thing, I mean, you look at the whole banking sector in Europe, it's an absolute mess, inclusive my home banks where I'm originally from in Switzerland. I mean, to me, they're trading at levels that no one ever thought of in the wildest dreams 6-7 years ago. So look, I think generally there is not, you can throw so many reasons at buying gold as a safe haven. The bottom line is everyone is responsible for themselves, their own financial health and wealth. And I think there's just so much reason now to even double up on gold holdings and gold stock holdings. It's not funny. But I mean, the timing of it, if someone happens to be a trader, is always questionable. We think we had a good correction in gold stocks. We think gold stocks are from here onwards an opportune buy. But again, selectively. I mean, we like Gold Corp and the Barrick overseas. We like domestically. I mean, Newcrest is a bit of an overloved story. It sort of went way ahead. It had a good correction. But look, bottom line is you've got to hold that sort of stocks because ultimately they are mining an asset that is very hard to get in a few years' time, in our view.
Markus, Tony Davison from Henderson Maxwell here. I'm just sort of interested when I look at the commitment of traders' data on the gold futures contract at the moment. We're seeing producers at a record net short position for the last 5 years. So in other words, they're pretty much hedged out a lot of their production, yet we've seen speculative money, which is way ahead on the long side at the moment, suggesting a little bit of a bubble in terms of positioning. You know, how does that sort of augur with your view that we would expect a lot more upside at the moment for the gold price in the next few years, given producers, who should know their market pretty well, are very short at the moment?
Well, I think that probably will ensure that the gold price or silver price doesn't race away too quickly in the next 3 to 6 months. Well, you never know. There's always an if and but. I mean, if you have a full-blown European banking crisis, anything is possible, of course. And as we know in history, many producers also can get it horribly wrong and be overhedged to buggery in light of the markets just running away from them. So I think it's a fair comment. I think gold, silver and related gold stocks are in a corrective cycle still, and that could easily go on for another 3 or 6 months for all I know. But I think technically, if you look at the technical long-term picture, we are now in a renewed bull market, so it's just a matter of how deep this particular correction goes over the next few months, if it happens to continue. But look, I just find that the net demand, and we have some bullion dealers as clients, but let's just see the actual net physical demand in gold is astronomical. I mean, we have the Chinese basically taking it out of everyone's hands. And look, I just wonder about some of the data or the usage of that going forward, knowing full well we have an extremely high-geared world economy, from Japan to China to Europe and the US and here. And hence it doesn't need much. It doesn't need much of a trigger to put some serious fright into investors' minds. Hence, I don't think this correction in gold and silver, even so you might see producer forward selling, well, their job is also, of course, to lock in a certain price, but I still think they actually might get a bit burned with their forward positions.
Hi Markus, it's Michael Wayne from COSEC. A few weeks ago now, we did get a bit of a taste of the bond market selling off and bond yields moving higher globally. Does that concern you from a long-term perspective, or do you think other factors have more bearing on the gold price going forward?
Well, I think, look, the short rates probably have a bigger impact on gold than the long rates, in my view. And I mean, essentially, after a 35-year credit bubble build, that's where we're really at, since 1981, I think a falling bond market, especially in the long end, the 10 and 30 year in the US, probably will just build in what the job of these long-dated bonds really is to build in risk, and risk not just from an inflation point of view, also a default risk, sovereign default, bank default, and so on. So a bond market's job is to build in risk, and if a bond market, a 10-year or a 30-year bond sells off, that could probably go hand in hand with a rally in gold.
All right, I want to switch to oil briefly, Markus, as well, because obviously we had the OPEC informal meeting last week, and I'm interested to get your view on what that means for the oil price going forward and whether you think it will all come to fruition as planned.
Well, as I mentioned the last couple of weeks, I mean, the OPEC's job was to stabilise the beast, and I think they're doing finally a job at that, and they're probably going to seal it in November. We all know to ratify all these agreements is now impossible. However, just the language itself and the commitment and throwing Russia in out of OPEC as well, I think basically just gives a floor price on crude oil, which I think has been $40 to $45. If you look at oil stocks, for example, you look at Royal Dutch Shell, they've got a bit of life back. If you look at Woodside, which is probably my favourite one of the whole lot in the moment, they're showing life, and for a right reason. I mean, this whole oversupply, it will take time. I mean, a production ceiling means simply that it will take time for the storage scenario to run itself down to such a level that it warrants price rises. And I think the market has to build it in. The first market to build it in is, of course, related stocks. And I think they are a tremendous buy at current levels.
Would you agree with that when it comes to Woodside, Michael?
Yeah, in some sense, I agree with Markus. I do think that OPEC coming out, stating what they've stated, basically does put a bit of a floor under the oil price. I think it, in reality, doesn't really have that much of an impact. OPEC are talking about removing sort of 750,000 barrels a day from the market, when in the most recent figures coming out of Russia, they're pumping at post-Soviet era highs and adding sort of 400,000 barrels a day. So you can see that any sort of supply coming off from OPEC is being picked up elsewhere. However, it just shows their intent to support the price around those levels. I do think ultimately oil is still capped at around sort of $55 for the moment. I do still think that a lot of the oil producers and shale oil producers in the US can easily come back online at those sorts of prices and start to contribute to the oversupply again. So I do think that medium to longer term, we'll start to see that supply absorb, but it is still a good year or two away, in my opinion. I don't mind the oil producers. I much prefer oil producers over, say, the iron ore producers. From a short-term trading perspective, it is a very highly speculative play. I actually don't mind Santos around these levels, because if we get the Australian dollar pushing back up to 80, Santos have a lot of US dollar denominated debt, so the rising Australian dollar is actually a positive for them, as well as the fact they're probably most leveraged to any increased oil price from there. But it'd be a very small portion of the portfolio, and it's highly speculative.
Right, because Tony, Santos is up 3.3% today.
Yeah, look, it's come a long way, though, from its recent highs. You know, the recent weakness, you know, had a fantastic rally, really on the back of the prospect of improving conditions, you know, and survival of the business, and then it's come a long way back from there again in that past couple of weeks. You know, for ours, it's a highly wound-up trade. Santos is probably implying, in terms of WTI prices at the moment, somewhere around $55 to $60 a barrel. You know, the stocks have really sort of run a long way ahead of the reality of those underlying markets. And to Michael's point, I would imagine you will see a significant amount of supply come on stream if you have sustained oil prices above $50 for any period of time. Shale oil producers have actually shown up to be very deft in their ability to actually reduce costs and get supply back on track.
Switching gears again, Markus, back to you, because I want to talk softs as well before we go. Obviously, agriculture, you've been looking at them as a great bottom pick, I know, looking to diversify. Talk us through what this is predicated on.
Well, why our head of commodities, Brendan Dart, is our grain desk specialist for many, many years. Look, basically we have a similar to oil in a totally different fashion, but it's also a massive supply story, oversupply, may I say. But the fact remains that the likes of wheat and corn are at levels, if you inflation adjust the price of it, probably goes to the low 80s or 1970s even. I mean, it's extremely cheap for a reason. Nevertheless, we think there's opportunity long term, and selected grain stocks, they're a bit harder to trade, but for example, Australian Agricultural Company had a very decent correction over the last few months. We just went long again over the last couple of days in ASC. Today it just came out and just raced away a bit, up 6.5%, I think, latest. Look, generally, for as much as we like gold, I mean, you can't just throw everything in one basket. We basically recommend people to have 10% of their net assets in gold and gold stocks. But on the other hand, health stocks, and particularly agricultural stocks, and also agricultural commodities trading into CFDs and futures, to me are something that investors should be looking at, because they have a very base low risk simply by the pricing, the current pricing of $4 a bushel in wheat.
All right. Markus, we'll leave it there with you, but appreciate your time as always on the program. Thank you.